I, I hate to use this phrase because I think everybody's used it over the last 2 years, but we do really live in interesting times. When we look at some of the things in capital markets, there's been extreme market volatility, a whole host of reasons for that. Geopolitics comes into it a fair amount, the tensions between the US and China at the moment, the tensions between Russia and the rest of the world have been causing many, many problems for financial institutions out there, including on the sanctions front, because that's an ever-shifting landscape that firms have to keep an eye on. On the retail trading side of things, last year, I believe it was last year, or was it the year before? I'm losing track of time. We had the GameStop and the meme stocks in the US that was focused on by the regulators. There was a lot of discussion at the House Financial Services Committee in the US about the trend there and the influence of social media and some of the apps on trading activity, and whether we should put a stop to that. But certainly one of the interesting things with regards to data is that data is coming from everywhere now. We're literally drowning in data as an industry, and the quintillion is putting it into focus there with regards to how many assets that we have to monitor and manage on a daily basis. And of course, I look at operations. This is where all the hard work is being done. There's a lot of challenges, particularly during the pandemic, to deal with the high volume of transactions due to the volatility. So people were working very late into the night, and that's continued, unfortunately. The volatility has been relatively challenging. We've also had a high level of settlement fails, which is another issue with regards to the industry overall. How do we bring those settlement failures down? What's causing them? Is it the data? That's something that regulators are focusing on in the UK and EU at the moment, and the US. So another big topic that regulators have also been focusing on, as well as financial institutions, is operational resilience. Now, as I mentioned, Russia, but we've got a lot of nation states out there that have upped their cyber crime operations. We've also got the potential threat of quantum computing in the future if we look out beyond current horizons. So that's something we've got to be ever monitoring and be careful around. So in reaction to that, we've seen EU regulators come out with the Digital Operational Resilience Act, or DORA the Explorer, as I like to call it, largely because it really wants you to get a close handle on all of the relationships you have, the dependencies you might have with cloud services providers, for example. So what does that mean on the day-to-day operations front? Well, you're having to assess your third, your fourth, your fifth party providers much more closely. That's made onboarding for vendors much more challenging from that perspective. It's also made the lives of consultants much more lucrative, shall I say, on that front. When it comes to operational risk and resilience, there's been much more focus on operational monitoring. I think we've done a relatively good job of monitoring operational risk in the past, but we need to get much better around that. So I think a lot of the other risks have been better monitored, unfortunately, and not enough effort or focus has been on, or budget for that matter, has been on operational risk. And the regulators would like to see that improve. So another continued pressure, if we want to look at things from a commercial perspective and a sort of market perception perspective, is the need to move to the cloud. Now, this has been a long, long journey. Some industries moved a lot faster than financial services. I feel like capital markets have been relatively slow overall, particularly the front office and customer-facing aspects of capital markets moving to the cloud. But certainly there is much more focus on it now, and you see cloud-first initiatives across a lot of financial institutions, including both asset managers and banks. I would say globally, I do have research on this, the US has moved a lot faster than the continental Europe, for example. I think the UK is a little ahead of continental Europe. There's been a lot of reasons why, but certainly there's much more pressure on all comers to move to the cloud. And I think the pandemic helped on that front with regards to data access and things like that. The regulators have not forgotten about this, the potential risks this might involve, and concentration risk with cloud providers is a certain focus of DORA, but it's also something we're going to see particular regulation around at the EU level, likely more at the UK level as well. And there's more pressure on firms to establish multi-cloud arrangements, so not being tied or locked into one provider from the cloud perspective. However, that is almost cost prohibitive. If you wanted to have two clouds and building all your technology in two clouds, that's not something that's sustainable. There's been a lot of pushback to the regulators on that front, but I think that's where data disintermediation layers come in, and that's something that I will touch on in a bit. Another sort of big change is the focus on having a C-suite role for people that are looking at cloud providers, assessing them properly. I've had lots of interesting conversations with CTOs at various banks and asset managers. The power balance between a financial institution and a cloud provider is slightly challenging. Obviously, it's very hard to get a large cloud provider to provide you with all the information that you need sometimes, particularly when it comes to cybersecurity and things like that. They may not always view you as their priority, because they do have lots of different fingers in different pies. I'll put it that way. Another sort of commercial imperative and some of the challenges I've seen out there relate to the focus on application programming interfaces, or APIs. They've been around for donkey's years, let's face it, but certainly there's much more pressure across all areas of financial services to adopt a more open architecture, be able to access data in a more rapid way, internally as well as externally. I'd say it's probably more progressed in the open API side of things when it comes to things like PSD2 and things like that have forced change in the retail banking space. I'm actually going to be speaking at another conference later this week on the lack of progress in capital markets on this front. But I think there's a number of reasons for that, but interoperability has been lacking, should we say. And there are some challenges with regards to cyber. And obviously, you need to be able to make sure that your APIs are not open for opportunities for cyber criminals to attack them. There's been a lot of proof around them being, if you don't build them properly, they can be portals into your organization that you may not be monitoring well enough. But also, another side when it comes to data and data quality is that pulling something from via an API directly from source systems can expose your clients, your internal users, to very poor quality data sometimes if it's not being properly maintained. So this is another area where I'm seeing effort and focus on data quality toolkits and data quality measurement to be able to help ameliorate some of those problems. Now, another thing to look at is the shortening of the settlement cycle. The US has committed to moving by 2024, and Canada, I should say. India is moving at the moment. They started in February. They're going to be finishing that journey probably mid-next year. They're doing it in a phased approach. I imagine the US and Canada will do it in a big bang approach for settlement. We moved to T+2 in Europe and UK in 2014. It wasn't that painful a move, but this one's going to be even more painful. In terms of the challenges there are numerous challenges. We have a lot of batch-based systems that run over several cycles over 2 days. They don't necessarily scale so well when you look at doing it in 1 day. But we have to figure out that it's going to be more like this. The yellow is T+1. This is the likely outlook by 2030. I've spent a lot of time talking to regulators in various corners of the world as to who's probably going to keep pace or try to keep pace with the North American countries. So certainly it's going to look a lot different. So if you compare this, which is the orange is T+2, the other colours are sort of slower settlement cycles. Obviously, China's on a T+0 for its internal settlements. Obviously, that causes its own problems because real-time settlement is very challenging. But I think in the future that we are moving that direction. We're going to have to rethink the way that we do things, the way that we manage risk, and the way that we manage our operations overall. So if we look out to 2030 and beyond, there's going to be a lot more pressure to reduce the settlement cycle as much as possible because of the desire to reduce counterparty risk. Obviously, the longer the settlement cycle, the more risk there is. Now, turning to sort of the data side of things, I've spent a lot of time surveying chief data officers across the industry, both buy side and sell side, banks, asset managers alike. Silos are continuing to cause a lot of problems. There's lots of them out there. 48% of firms I surveyed last year said that they were causing massive problems on the business side due to these silos being incompatible data being pulled from them, and a lot of pressure to be more real-time in making decisions, and that causing a huge amount of legwork, let's say, and skilling up across the teams. There's also an ever-increasing supply of data assets to manage. And I mentioned people are drowning in data. That really is true. If you think about things like ESG data, sustainability, climate risk, all of these different things we now have to factor into business decision making. Not to mention, all of the regulatory data sets we now must maintain. And they're all slightly different flavours per jurisdiction. So regulators never like to agree on exactly what they want from you. So they all come out with slightly different requirements for reporting. So that makes life interesting for everyone in compliance and in data operations, unfortunately. And I don't think that's going to change anytime soon. Poor data quality is obviously relatively painful. You have a huge focus from the regulators on data quality at the moment. I didn't put up the fines here because I didn't know who was going to be in the room. Obviously, I don't want to name and shame, but there's been a huge number of fines, and they are increasing in frequency and in cost from regulators, from everything from MiFID reporting through to things like GDPR. So data is a big focus of the regulators going forward. They're also investing themselves in their own data architectures to be able to interrogate the data that they receive from you guys. So I've seen massive investments made by the FCA, and in the US, the CFTC and SEC also investing. They may be a bit slow in implementation, and the purchasing cycles are infernally slow. You think yours are bad, they're even worse. But certainly that's something that's very interesting to view. And they want you to be able to back up all of the things that you're doing on a business side with systems and controls. So making sure that your operations are airtight and you can answer any awkward questions that they have on demand. So obviously, all of this, we live in an ESG environment, so everything you do is being judged on many different things at the entity level. So I'd say it's even worse because of the governance focus of buy-side firms and sell-side firms has increased. You can have a hugely negative impact on your client trust, the perception of you. It can impact your share price if you're caught out for being asleep at the wheel, as it were, in terms of your reporting and sometimes even your own operations, particularly around client data and things like that, given there's been an increase in hacks. So obviously we know that these things are not easy to deal with. Getting your data details right is not a simple task, and accuracy is a significant challenge, but consistency is equally a challenge there. So these things cause problems when you're trying to make any kind of decision at the business level, be that the trading desk, be that the risk management side of things, looking at assessing your counterparties, monitoring sanctions, for example. All of these different things require accurate, fast, and consistent data so that you can consume it across the organisation. And I think we're building even more tools on top of things to be able to provide front ends direct to client, as I say, with an API, with new tools on the front to be able to make sure that you're doing a really good job of serving your clients out there. So data details matter. The good news is that we're seeing more people in the role of Chief Data Officer. It's gradually increasing. I have this over time, but as of last year, actually as of the start of this year, in fact, these numbers haven't changed too much. We have nearly 50% of the large global investment banks have a Chief Data Officer in play, and slightly less on the asset management side of things. The only challenge here is that we have a lot of these people cycling in and out of these roles very quickly. I did look at tenure. Average tenure is a year, 6 months, which is probably not the best indicator for long-term viability of the role, but I think that's for a number of reasons. Largely because some of these chief data officers are coming into play, not being able to solve problems that they don't have the budget to solve. The C is misleading. I sometimes see them as chief scapegoat officers. I make jokes about that because they get blamed for all the organisational problems that they can't fix, and then, lo and behold, they move on to another role relatively quickly. Saying that, there are some chief data officers that have been there several decades now, so, going into double digits at least. So there are some people that have been in the role for a long time. They've managed to affect change in their organisations, and they are talking to people about how they've done a good job and how. I wrote an entire report on the key qualities that a chief data officer needs by using these people as good examples. But one of the key things that you have to do is maintain communication. I think that's where a lot of challenges come in, is because it's a central role. you have to deal with so many business stakeholders. It's a bit of a political minefield. So that is one area that I think a lot of chief data officers are now taking into account much more when they're starting their careers and more starting into the CDO role, is how much is keeping your stakeholders happy and making sure they understand what you're doing and that you're not talking to them in IT speak or in data speak, which can be alienating for people at the lines of business heads. Another positive story here is data quality investment is increasing. We're seeing much more focus on data quality tools. We're seeing more focus on data integration tools, data aggregation tools, data fabrics. There's more of a strategic impetus to sort out data problems or stovepipe all of those different silos and be able to deal with things that you may have chucked into a data lake that you need to dredge. Or, for that matter, end systems that are not going to be retired anytime soon. I don't think we'll ever get rid of some of these systems. Unfortunately, things are going to sit there for a while. I know that everybody wants, the bane of most people's lives is these legacy applications, but it does take a really long time to get rid of them if you try it. And there's a huge amount of project risk, particularly if they are it's like trying to change an engine of a plane whilst it's in flight. So I can understand why people are wary of actually trying to rip and replace anything from this side of things. So data tools become strategically important to your business, which is a great thing. I love to see recognition because I think data's been overlooked for too long within the technology sphere. There are many different strategic reasons for investing in data management. I look at lots of different business cases. Operational risk is obviously one big one at the moment. Sometimes people are tying it into regulation, but quite often that's when you get fined as an organisation. I see panic buying after people get fined for data quality problems. That's I guess, always guaranteed budget, but not really necessarily the budget, not the business case you want. I think there's a lot of focus on efficiency at the moment, reducing manual processes, trying to reduce team sizes, particularly around regulatory data support. There was a lot of sort of firefighting initially, post 2008. People skilled up, got lots of teams on board. Now they want to reduce those teams globally, There's been some harmonisation at the regulatory level in areas like derivatives. Hopefully I'm not speaking Greek to you guys and you don't know the areas I'm talking about here, but there was a huge amount of focus post-2008 on derivatives as a key risk area. And that involved a lot of data crunching and pulling data out of systems that just nobody really been pulling that kind of data out of. So there were a lot of problems there. Now I think a lot of firms are trying to make that a better process. And we do have critical data elements that are sort of being adopted consistently across numerous regulatory regimes in that area at least. Obviously, client demand, client pressure to improve and modernise. As I've mentioned a few times before, there's huge pressure from clients that want to see more reporting. They want to understand why you're making the decisions you're making, particularly on the institutional investor side of things. Pension funds and things like that want a lot more transparency around certain things related to governance, and ESG has been a big driver for that on that front. So, and I think even on the wholesale banking side of things, ESG is becoming a big pressure at the entity level. So many different aspects there. There are also a lot of other benefits with regards to data management. I'm sure we're going to be talking about these on our panel session, but just to touch on a few. Next-gen technology adoption, there's a lot of buzzwords out there. At the moment, obviously AI and ML seems to be something that many firms are trying to trial. I see a lot of hurdles, bumps related to data that happen. If you've got poor quality data going into an AI, it doesn't spit out anything even vaguely useful. People also don't understand how long it takes to train an AI. I think that's we were even creating sort of synthetic data to feed into AI tools because we haven't got enough data internally. If you're a smaller organisation, that can be challenging. So there's a lot of different opportunities to look at data and to build data architecture to feed into these technologies to make them more useful, particularly at the operational level. Now, there's a lot of product innovation. Dare I mention, I hate throwing buzzword bingo at you, but digital assets is a big topic here. Mixing digital assets with traditional assets, not necessarily the easiest thing to do. Certainly, product innovation is always the bane of data managers' lives because they come up with something new and you have a new data set to maintain, that you're pulling data from different areas. That's very challenging. And obviously that feeds into the competitive advantage over your peers. Hopefully, that's the sort of data services side of things as well. If I'm looking at some of the large asset services, custodians and the like, including as well as investment banks and asset managers, they're building a lot of things around data, trying to make sure that they can commercialize things or try to commercialize things from the data side of things. Obviously, you have parameters, and you have to be very mindful of those as to what you can do with client data. GDPR being one area where you have to be very careful about not being in what's the word, non-compliance with. So certainly you have parameters. You also have licensing restrictions when it comes to dealing with data vendors. We all know if you deal with Bloomberg, that would be a good example there, for example. They aren't necessarily letting you do everything you'd want to do with the data, but there are definite parameters that you can build on top of or work within the confines of. Now, the 10-year outlook, I'm going to touch on very quickly, but I always look far out. So as I mentioned, settlement cycles are coming closer to T+0, so netted T+0 rather than real time, because I think that would kill a lot of businesses out there if they were real time. ESG, environmental, social and governance investing is now becoming increasingly embedded across the globe into everything that people do. I think that's going to continue. Climate risk, climate change is not going away anywhere. So climate risk at the very least is something that we have to deal with. As I mentioned, multi-cloud is a big push, making sure you're not locked in. And legacy replacement projects are continuing to pick up speed, albeit they're coming from sort of walking pace to maybe not even jogging pace yet, but they're progressing at least. They're moving forward. Digital currencies and digital assets, for that matter, there's a lot of regulatory change in that space. I spent a lot of time listening to people talking about regulation and how to best address digital assets. But I believe we're going to get proper regulation, MiCA in the EU, the UK's own version of it, and the US within the next year. It's all shaking out slowly. There's also, as I mentioned, cyber criminals that we have to be very, very careful of. They are more innovative than we are. They're faster moving than we are. And if anyone's going to pose a threat to us with quantum computing, it's them to be able to hack and be able to get past encryption. Certainly that's something that you have to have on your horizon for the 10-year outlook. We may not have quantum computing by that point, but it's certainly something to bear in mind. Automation is also going to be replacing many more jobs. I think that's just the general trajectory we've had over the last 10 years. That's going to continue on. I think there's a lot of focus on trying to allow people to get rid of the grunt work. Because let's face it, we do a lot of things that we shouldn't be doing on a day-to-day basis, for data cleanup in particular. Reconciliation, I mean, I do spending estimates for technology and reconciliation. We spend a huge amount as an industry on reconciling data that we shouldn't be doing. It's wasted money, especially when it's just internal recon. And with regards to the outlook for providers, I think there's been a lot of focus on consolidating your relationships with vendors so that you aren't working with tiny vendors all over the place. You want to be working with trusted partners going forward, and that's something, again, I've seen general trajectory over the last 10 years. It's due to continue forward. Now, there we go. Hopefully I gave you a whistle-stop tour of everything.